Hello and welcome back to Hank USA. I'm Hank. If you have money sitting in a bank account, there are two numbers every senior needs to understand, and most people have never been told about either one. Both can have a real impact on your financial security. The first number determines whether the IRS is already tracking the earnings on your savings and quietly adding them to your future tax bill. The second determines whether your money is truly safe and protected, or whether you're relying on a false sense of security. Today, we'll break down both. I'll explain why they matter more now than they have in over a decade, and lay out the specific steps you can take this week to protect yourself. This is exactly the kind of financial detail that erodes savings without any warning letter, and it usually only shows up as an unexpected tax bill or a loss you can't recover from. Before we start, please give this video a like, subscribe to Hank USA, and turn on the notification bell. Staying ahead of these hidden financial rules is what we do here. Now, let's get into the first number, the one generating surprise tax bills for seniors across the country right now. Every dollar of interest you earn in a standard savings account is taxable income. That's true for traditional savings, high-yield savings, money market accounts, and certificates of deposit. To the IRS, that interest is treated no differently than wages, pension payments, or your Social Security benefits. And here's the detail that catches people off guard. Your bank reports all the interest it pays you directly to the IRS every year, automatically on a form called a 1099-INT. Before you even sit down to do your taxes, the IRS already has a record with your name and the exact amount of interest you earned. They often know your interest income before you do. This rule isn't new. It's been around a very long time. So what changed to make it a sudden problem? The math. For more than a decade, from roughly 2009 through 2022, interest rates on savings were practically zero. The taxable interest most people earned was so small it barely mattered. Say you had $50,000 in savings, earning 0.5%. That's $250 in taxable interest for the whole year. In the 22% bracket, the tax on it was about $55. Trivial, hardly worth a thought. Today, it's a different picture. Over the past couple of years, high-yield savings accounts have paid around 4% or more, and many still do. That changes everything. Take that same $50,000 at 4.5%. Now it generates $2,250 in taxable interest for the year. In the 22% bracket, the federal tax is $495. Even in the 12% bracket, it's $270. And most states tax this interest too, adding another layer. But it doesn't stop there. For a lot of seniors, this interest doesn't sit in a vacuum. It stacks on top of every other source of income, and that's where it does real damage. If you collect Social Security, the IRS uses a special formula to decide how much of your benefit gets taxed. It's based on something called your provisional income. You calculate it by taking all your other income, pension payments, withdrawals from a traditional IRA or 401k, part-time earnings, and, crucially, that savings interest, and then adding 50% of your annual Social Security benefit to the total. Here's where the thresholds matter. If your provisional income as a single filer goes above $25,000 or $32,000 for a married couple filing jointly, part of your Social Security becomes taxable. Above $34,000 single or $44,000 for a couple, up to 85% of your benefits can be pulled into your taxable income. This is where interest from a high-yield account turns into a hidden trap. Picture a senior whose provisional income sits just below $25,000. They've planned carefully and believe none of their Social Security is taxable. They feel secure. Then their savings account, which they haven't paid much attention to, throws off an extra $1,500 in interest they weren't planning for. That $1,500 pushes their provisional income over the $25,000 line. Suddenly, a portion of the Social Security they always assumed was tax-free is now subject to federal income tax. So the damage is twofold. The interest itself is taxed, and it triggers tax on Social Security income that wasn't taxed before. A small amount of interest leads to a much bigger bill than expected. Most seniors with savings accounts have never considered this. So what's the practical step? Estimate your own provisional income for the year. Gather your non-Social Security income, pension statements, recent IRA withdrawals, any part-time earnings, and add them up. Then look at your savings statements, find your average balance, and multiply by your current rate to estimate your yearly interest. Add that in. Finally, take your total annual Social Security benefit and add half of it to the running total. That final number is your estimated provisional income. If it's anywhere near $25,000 for a single person or $32,000 for a couple, your savings interest is no longer a minor detail. It's an active factor in your tax bill, and you need to account for it before you file. There are legitimate ways to reduce this exposure, though it's wise to run them by a qualified tax professional for your situation. The strongest one for this specific problem is a Roth IRA. Any growth or interest inside a Roth is never taxed, and qualified withdrawals in retirement are tax-free. Just as important, Roth withdrawals do not count toward your provisional income, so they don't push your Social Security into taxable territory. Now, a word about municipal bonds, because there's a common misunderstanding here that matters for this exact topic. Interest from state and local government bonds is generally exempt from federal income tax, and often from your state's tax if the bond is issued in your own state. That's a real benefit for the tax on the interest itself. But here's the catch. That tax-exempt interest is still added back into the provisional income formula. So municipal bonds do not shield your Social Security from taxation the way a Roth does. They lower the tax on the interest, but they still count when the IRS decides how much of your benefit is taxable. It's an important distinction that trips people up. Treasury securities, like T-bills, notes, and bonds, offer a different angle. The interest is subject to federal tax, but it's completely exempt from all state and local income tax, which is especially valuable if you live in a high-tax state like California, New York, or New Jersey. And Series 1 savings bonds give you timing control. You can defer the federal tax on the interest until you cash the bond, which lets you decide when to recognize that income and avoid pushing your provisional income over a threshold in a high-income year. Now let's move to the second number. And this one is about whether the money in your bank is as safe as you think it is. Every deposit account at a federally insured bank is protected by the Federal Deposit Insurance Corporation, the FDIC, up to $250,000 per depositor per institution. For credit unions, the National Credit Union Administration, the NCUA, offers the same $250,000 protection. If your bank failed, the federal government guarantees you get your money back, but only up to that limit. Anything above $250,000 at a single institution isn't guaranteed. You'd become an unsecured creditor for the excess and could wait years to recover only a portion of it. The key phrase, and where people make a dangerous assumption, is per institution. It's easy to assume a bank's brand name is the same as its legal institution, but that's not always true. Several well-known banking brands look like completely separate companies to the average customer, but actually operate under a single shared FDIC charter behind the scenes. If you hold money at two brands you believe are separate, but they share one charter, your deposits are only protected up to $250,000 combined, not $250,000 at each. You might think you're being careful by spreading your money around and still be exposed without knowing it. So what can you do right now? Go to the FDIC's official website and use their free Bank Find tool. Type in the name of each bank where you keep money, and it shows you the legal institution behind the brand and its unique FDIC certificate number. That's how you confirm whether your banks are truly separate, separately chartered institutions, or just different brand names for the same underlying bank. There's also a savings vehicle that skips the FDIC limit entirely, U.S. Treasury securities, including T-bills, notes, bonds, and I-bonds, bought directly from the government through Treasury Direct. These aren't FDIC insured. Instead, they're backed by the full faith and credit of the U.S. government, considered the highest level of financial backing in the world. And there's no dollar limit on that protection. A senior with, say, $400,000 in cash they want kept completely safe could hold the entire amount in Treasury securities with no portion left unprotected. The FDIC limit simply doesn't apply. The main trade-off is liquidity. Unlike a savings account you can tap anytime, Treasuries have set maturity dates and rules on early redemption, so they're less ideal for money you might need on short notice. But for the long term, safe storage of savings above the FDIC limit, they effectively remove the risk of a bank failure. So for anyone managing a large sum of cash, a practical structure comes into focus. First, keep up to $250,000 at a single FDIC-insured institution for liquid, accessible funds. Second, use a separate, independently chartered institution for another $250,000 after verifying with BankFind that the second bank doesn't share a charter with the first. And third, for anything above that combined $500,000, consider moving it into Treasury securities through Treasury Direct, where the protection on your principal is unlimited. There's one more consideration for married couples. Because the FDIC's rules allow for expanded coverage when accounts are structured correctly, a joint account held by two people with rights of survivorship is insured up to $250,000 per co-owner, so a single joint account is protected up to $500,000 at one bank. On top of that, each spouse could also have their own individual account at that same bank, each insured for $250,000. Put together, that's $1 million fully protected at a single institution. The crucial detail is that the accounts have to be set up under the correct ownership categories, because coverage is calculated per depositor, per ownership category: single, joint, retirement, and so on, not simply per account number. So let's summarize what to do this week. First, take a few minutes to estimate your provisional income. Add up your non-Social Security income, then add half your annual Social Security benefit. If the total is approaching $25,000 for an individual or $32,000 for a couple, know that your savings interest is likely affecting your tax bill, and it's worth asking a tax advisor whether tools like a Roth IRA or I-bonds fit your situation. Second, find last year's 1099-INT forms. Look at the interest you earned and the tax you paid. With rates still high, you can roughly estimate this year's by expecting a similar or slightly higher amount, so there are no surprises when you file. Third, go to fdic.gov and use the BankFind tool. Confirm that any banks holding significant funds for you are actually separately chartered, because spreading money across brand names that share one charter gives you no extra protection. The IRS already knows how much interest your savings earned this year. Make sure you know too. And just as important, make sure you know how much of your money is truly protected. As always, this is general educational information, not personalized financial advice, so check with a qualified professional about your own situation. This has been Hank with Hank USA. If this helped, please give it a like, subscribe, and share it with a friend or family member who keeps their savings in the bank. I'll see you in the next one.